Hi everyone, welcome to Easy Economics. In this video, we will study about different aggregates of national income as well as domestic income. There are 4 aggregates of domestic product as well as 4 aggregates of national product. In all, there will be 8 aggregates of the national income. The 4 major aggregates: gross domestic product, net domestic product, gross national product, net national product. I'll request you to please note down the first letter of each aggregate. For example, for gross domestic product, GDP. All these factors are expressed in terms of factor cost as well as market price, therefore making it 8 aggregates. Before we understand the aggregates, we need to understand 3 golden rules of national income analysis. The first, gross value less depreciation is equal to net value. Alternatively, net value plus depreciation is equal to gross value. Second, national product less NFIA is equal to domestic product, or domestic product plus NFIA is equal to national product. The third rule is market price minus net indirect taxes is equal to factor cost. Alternatively, factor cost plus NIT is equal to market price. All the 3 components, depreciation, NFIA and NIT, has been discussed in the previous video. Here is the summarized table of change for your reference. I'll request you to please take the screenshot of this table of change for future references. The first aggregate of national income is gross domestic product at market price. We write it as GDP MP. MP is written in subscript. GDP MP is the sum total of the market value of all final goods and services produced in the domestic territory of a country during a year. Next is gross national product at market price. GNPMP is defined as the sum total of market value of all final goods and services produced by normal residents of a country during a year. For deriving GNPMP from GDPMP, we need to add NFIA. The third aggregate is net domestic product at market price, NDPMP. It is the value of final goods and services produced in the domestic territory of a country by the normal residents and non-residents during an accounting year. It is derived from GDPMP by reducing depreciation. Here we need to know that any aggregate can be derived from the other aggregate by following the table of change. The next aggregate is net national product at market price, which is equal to the final goods and services produced in the domestic territory of an economy during an accounting year and net factor income from abroad. For deriving this from NNPMP, we need to add NFIA, and to derive it from GNPMP, we need to reduce depreciation. Aggregate is net domestic product at factor cost, which is the sum of net values added by all the producers in the domestic territory of a country during an accounting year. NDPFC is also known as domestic income. For deriving it from NDPFC, we need to reduce net indirect taxes. One of the most important aggregate is net national product at factor cost, NNPFC. This is also known as national income. It is the net factor income accruing to the residents of a country during a year. It is the sum of net domestic factor income and net factor income from abroad. That is, NNPFC is equal to domestic income plus NFIA. The seventh aggregate is gross national product at factor cost, GNPFC, which is the sum of factor cost of the gross product supplied by the normal residents of the country during a year. For deriving it from NNPFC, we need to add depreciation. The last aggregate is GDPFC, gross domestic product at factor cost, which is a sum of net value added by all the producers in the domestic territory of a country and the consumption of fixed capital during the year. For deriving it from GDPFC, we need to add depreciation. In NDPFC, concept of factor income and transfer income. Factor income we have already discussed in our previous videos, which means rent, wages, profit, interest, which are the payments done to the factors of production. As against the factor incomes, there are certain incomes which are unearned. These are known as transfer payments. For example, old age pension, unemployment relief, welfare payments, gifts, etc. For these transfer payments, there is no quid pro quo. That means nothing is returned in received. These unilateral payments are kept out of the purview of national income calculation. That means while calculating national income, only factor incomes are taken into account. For more videos, please follow